asking the hard-hitting questions you want answers to, but mostly just drifting off and staring blankly at the wall. It's the Big Biz Show with Russ and Sully.
Russ and Sully, Big Biz Show, bigbizshow.com. Good to have you. You can watch us live right there at bigbizshow.com. Takes you over to Wazilla Media and Ustream. Talking to a new website group that wants to advertise and trade their services. You ever done trade out?
Yeah.
Is that a good idea?
Love trade out.
Do we like that?
Sure.
I need to get a barter specialist on the air.
That'd be good.
See,
They're doing it all over.
I know I'm a one-trick pony. I know how to invest in stocks. I got to learn more about life. Like our next guest, David Arcangel.
Yeah.
He'll teach you how to defer taxes and make more money. Coming up next hour, Michael Rosbrook from Tax Resolution Services and the folks from Republic of Texas Brands will be with us. All that coming up next. Big Biz Show brought to you by Prudential. Let Prudential be your rock or retirement. Okay. David Arcangel, pick up a copy of his book, The Secret Asset. And you can go to his website, thesecretasset.com. Making millions with investment-grade real estate. Pretty good stuff. He's also a pretty prolific public speaker about this stuff. But what you really explain there, if you're just joining us on the radio, and basically we're talking about taking advantage of overfunding insurance premiums to gain a tax benefit is probably the easiest way to put it.
Yeah. What you want to do is you have to understand is taxes everywhere you go. You make $1, you lose 35, 40 cents in taxes. Then you go take that 60 cents, you go buy something, and they tax you on that.
Right.
Right. So the life insurance is the only vehicle I know.
Okay.
I said before, we call it the eighth wonder of the world. I'll give you an example in chapter 18 of the book, My Brother. A supplemental retirement plan that he can do himself where it's not regulated by the pension industry.
He's throwing a little bit of his own money away.
He puts $50,000 a year in the example in the book, from age 31 to 51, 20 years, so it's $1 million. At age 65, he retires. Based on the money, the excess cash, we bought the minimum amount of death benefit versus the maximum because we want to keep our costs down. You put the maximum amount of cash in, the minimum amount of death benefit, your costs are at the least. They invested in a hedge on the S&P index, 0 floor, 13% cap.
What that means is that means that you can beat the S&P by just following his advice here. So it's almost like a forced. I've described this when Tyler was playing guitar here for the show.
Yeah.
I said, Tyler, go buy yourself some whole life insurance. You're 20 years old. You'll be able to buy a house by the time you're 30. And that's the reason, right?
Yeah.
It's a forced savings account for a kid like that.
Right.
For us, it's a retirement plan. Now, what do you say to the people that, and you've heard this a million times, I'm going to say it again, because I'm already getting emails.
Yep.
What about buy term, invest the difference? What that means is instead of overfunding the premiums, take that extra $100 you're going to overfund the premium, invest it yourself.
So I'll answer that, but the finish on My Brother, and then I'll answer and dovetail into that is the S&P has done without dividends over the last 20 years about 8.4%.
Right.
So let's say we do 7. Over the last 10 years, if you were in the S&P, you got 0.
Right.
But if you had a 0 floor and a 13% cap, you would have been up about 66% approximately.
Exactly right.
So wait a second. So you didn't lose money. My brother, in the example in the book, after 20 years of putting $50,000 in, he retires at 65 based on 7%. Yeah. Not 8.5 or whatever it is. You could take out, based on the illustration, $462,000 a year tax-free for 15 years.
What?
It's $6.4 million tax-free.
Okay, so let me read you my first email.
Yep.
This is from Jim Thomas. Jim Thomas is listening to us in Dallas, Texas, KVCE.
Oh.
He says, I'm 50 years old. Is it too late for me to start? I've attached this. I don't care what he attached, but the long story short is 50 years old. He's 50 years old.
Yeah, you're 50 years old. You're not too old to start.
Well, the good news is you could, if you're 50, you're probably making more money than you were when you were 30. So you could fund this thing a few $1,000s.
Correct. Yeah, you could fund it. Buy term and invest the difference. You can do it now in the same product.
But let's say this. Let's say this guy here with your illustration takes $4,000 a month, like you said, $50,000 a year for the next 15 years. Yeah. Is that enough time for him to supplement his retirement?
Yes.
So that's 15.
Absolutely.
So that time horizon's okay, because I'm just saying 60. I'm saying 15, 65 years old, right?
That time horizon's okay, and it works great if you're 20, Great if you're 30, 40, 50, it works good. It's not as good as when you're 20, but it's still better than almost anything else out there.
Right.
Wow.
Well,
Because where else can you put your money in? You paid the tax. You put the money in this, and you never, ever pay taxes on the
what
interest,
that means is
dividends, or capital
because
gains.
you're paying for the insurance with after-tax dollars.
Yeah,
Okay.
correct.
You've already been taxed on it. You're purchasing it as an asset, and what is the IRS reasoning for not taxing the gains that we're talking
The
about?
IRS gave the insurance industry years ago a little benefit that is now a big benefit called Internal Revenue Code 7702 that basically says they wanted to encourage the public to put your money, buy life insurance, cover your family, and the money inside there can grow tax deferred that helps pay future premiums.
Right.
So you can structure that a variety of different ways. Life insurance, most people just go, what's your age, what's your date of birth, how much life insurance,
Yeah.
they press the button. That's lazy.
Yeah.
You want to push back the screen at software, there's thousands of variables, so you maximize it.
Yeah.
So
right.
that's what you do. It's
So
all
you're
mathematics.
basically trimming your sales here. By the way, what we just talked about is in chapter 18 and 19.
Yeah.
All spelled out in the book, The Secret Asset, Making Millions with Investment Grade Life Insurance. So the two lessons we've learned in the short time we've been with David are, number one, start early is better than later, but later's not too late. And number two, you can tax defer, withdraw your cash tax free if you start this stuff. So I want you guys to take a look at the book and do that. Next week, I want to talk about life insurance trust with you, because
Trust?
Well, people put their, there's in financial planning, there's a living trust, there's an
Yeah.
irrevocable trust, there's an irrevocable trust, and if you have life insurance, there's a life insurance trust. And there's a reason that you do it, and most of it is to avoid taxation. The death tax is basically what it comes down to. We'll talk about that next week. I don't want to confuse too many people. But as a parting shot here, why don't you think more people are taking advantage of this?
I would call life insurance two things. Most people have it wrongly positioned in their mind because they've heard the story incorrectly, and they relate it to death.
Right.
And most people bought it incorrectly, and they quit. They never understood it.
Right.
So what we do in the book is we empower you with the information so you have the information you need, and you stay and go the distance. The people who quit subsidize the people who stay.
David D'Arcangelo, ladies and gentlemen. Man,
Yeah. I hate you. Go away.
The Secret Asset.
That's great.
TheSecretAsset.com. Thank you, David. We'll see you next week. That's good stuff, man. How do you beat that? Free money, especially. Yeah, I'll see.
You need to contact a guy like David to get this straight.
Yeah,
I would imagine.
That's exactly right. Russ and Sully on the Big Biz Show, BigBizShow.com.